Hi everyone, this is Rob Roy and welcome to the Elliott Elite US market update. If we take a look at the chart, you'll see that the market rally is still continuing, although pausing just a bit. We'll get to that here in just a minute, but you can see that we have an extended wave 5 based on the Elliott wave count, and as you know from 5-wave Elliott wave counts, once you get an extended wave 5, you're starting to look for a correction. Now, when we talk about these updates, we don't want this just to be a regurgitation of what happened in the markets. We want to throw in some education as well. And many of you, I'm sure, because it's been taught that way, that when you're trading an Elliott wave pattern, the 5-wave directional trending pattern, you don't trade the wave 3, you don't trade the wave 4, you wait and either trade the wave 4 to the 5 or you trade the 5 reversal back to the 4. I think that's ridiculous because we all know that the wave 3 is the strongest wave. So why can't we trade that? Well, how do you trade that? And I wanted to show you something because the market is given just an absolutely classic, perfect indication of one of the primary corrective patterns within Elliott wave. I know you've been taught directional patterns, but many of you likely haven't been taught corrective patterns before. And there's a pattern known as a zigzag, and we have a really good one here in the wave 3. This is how you can trade the wave 3. So if you take a look at this, even someone that's a novice in Elliott wave can see that we have a pretty good impulse move here, and that was preceded by just a little minor ascending triangle right here. Wasn't a very big one, but it was enough to kick off the Elliott wave pattern to the upside. So let's take a look at the impulse pattern to the upside, rather. So let's take a look at where this impulse started, and we will start with the Elliott wave retracement tool right from the beginning of it, move it up to the edge, and notice that we had that impulse move right up to the top where the arrow finishes, and then on the corrective move we came right down here to the 61.8% Fibonacci corrective level. That's just absolutely classic for what's known as a zigzag pattern. So when we look at this, once we hit the 61.8% retracement level, your exit strategy is if we come down and hit the 78.6. That tells you that this has been nullified, it's no longer a valid pattern, and you get out. So that's where your risk is, just this small amount. So that would be your stop, if you will. But we never did that. We did come down and test it. That happens sometimes in a B wave retracement. And then we extended on up to the C wave. So let me illustrate this for you in a zigzag count. So that first move there would be labeled as A. These are ABC patterns, not labeled 1, 2, 3, 4, 5. They're labeled ABCs. And so we come down here with our wave B correction down to the 61.8% level. So you see that here. And I'm going to come back and note something that's within there here in a second. So then we're looking for where do we go from here. So that's our entry at the 61.8% corrective level. And when you have a 61.8% Fibonacci correction in the B wave of an impulse pattern or a zigzag pattern, you are looking for a 100% extension. So then we bring out the Fibonacci extension tool, start down here where the beginning of the A wave was, we measure that, then bring it down to where the B was, and we're looking for a 100% extension. And isn't that fascinating that the C wave extension, the 100% extension, goes right to where the wave 3 ended. Look at all this resistance in here, right at the 100% extension. And then we came down, tested the previous fib level, this 61.8% level right here. So we came up, we have all this resistance, which is expected because it's a 100% extension. We come back, test that level, and then we take off again. It's extremely classic zigzag pattern. So we take a look here and put the C, and there's the completion of our zigzag with the A, B, and C. So the chart's starting to get a little convoluted, so let me take some of this stuff off, and then I'll show you another couple of cool little things here that were in the pattern. So it's just not that difficult to trade the wave 3 if you know how. And then we had that test there. The wave 4 was the test, remember, of the previous fib level. So that coincides with the wave 4, classic Elliott wave stuff there too. And then we come up and we have a triangle, which is another corrective pattern. And we like to focus on triangles with other option strategies as well. But that's a corrective pattern. So the corrective patterns within Elliott wave are zigzags, triangles, and flats. And so when you have a triangle pattern, you likely already know that you're looking for a breakout. And what did we have? We had an impulse breakout for the wave 5. I mean, it couldn't be any more classic Elliott wave methodology than what's occurring. And now where are we? You likely have learned this already just in your wave 5 trending Elliott wave education, that following a wave 5, you quite often go into a consolidation period. And so we have another small little triangle there. The wave B here, actually, when we look at this, was a little bit of a descending triangle because we had some bounces. It wasn't a mono wave B. We bounced around a bit, and so we have a little bit of a descending triangle, and that was the catalyst for the move up to the wave C. So just again as a reminder, the trade would have been you enter here when you hit the 61.8% level, you exit as soon as you reach 100%. That's it. That's all you're looking for. So that's the zigzag rule. Then you can move into your traditional wave 4 buys and sells and wave 5 buys and sells on trading the 4 to the 5 and then the likely retracement. Well, at this point, the market doesn't seem to want to correct, does it? And we all know at some point we're going to get this correction from the 5 back to the 4. All that matters is when does that occur? Could the wave 5 extend further? Sure it could. We could actually break out of this little triangle and go higher. Just because we're already in an extended wave 5 doesn't mean that we have to stop here. It could get even further extended. So if we go take a look at the SPY, which we look at, it's an ETF against the SPX, because that brings volume into the mix, and we always want to look at volume. As great as Elliott Wave is, as great as all these wonderful tools that Profit Source and Integrated Investor have, there's no substitute ever for price to volume action. Now, one thing you can note here is this red line is the 200-day moving average for volume. Notice how it's sloping down. So volume has been declining throughout the entire time that the wave 5 has been moving up. That's divergence. So that tells you that the further this wave 5 goes, the weaker it is. Again, not telling us that it's going to correct tomorrow, but the signs are there that, hey, we need to start keeping an eye on the market for a correction. So taking off that arrow, note that here towards the end of last week, we've had a little bit of an increase in volume, which is interesting as we're starting to move into the holiday period. We have Thanksgiving coming up this week in the U.S., and then after Thanksgiving we go into quickly looking at the Christmas holidays and then the period of time between Christmas and New Year's. So normally volume begins to dry up. So it's interesting that towards the end of last week we had a little bit of an increase in volume. We'll come back in a minute and talk about what could be some catalysts to cause this reversal to occur. But before we do that, let's look at the VIX, because we've had a little bit of a bounce up in volatility over the past week. Nothing real significant. We tried to have a little bit of a good spike here on the 15th, and we came back down, closed near the bottom of the spike, and then we've been heading back down again here at the end of the week. Note that the low here on the VIX is around 9. I wanted to show you a monthly chart of the VIX so you can see that historically we're going all the way back into the early 2000s here. We are at the very low end of the range for volatility. We have a little bit, even on the monthly chart, of a descending triangle here. We just talked about triangles. What does that mean? It means a breakout. It doesn't tell us definitively which direction we're going to break out. It just says we're going to break out. So with that in mind, you tell me. We could break up or down. It doesn't give us a direction on the breakout, but which would be the path of least resistance, to the upside or the downside? Clearly the upside, right? And if more volume, or more volatility comes in, then that ties right in with what we're looking at as far as the end of this wave 5 and getting the reversal back down the previous 4. So the VIX is starting to confirm that. So things are starting to line up. However, we are dealing with this market that it doesn't seem like anything can derail it here in the U.S. Market just seems to go up. Doesn't matter what news comes out, North Korea, any geopolitical stuff happens, and the market just keeps powering ahead. When we have a market like this, we usually get to a point where we need something like a black swan, an unexpected event. And watch for a webinar here in the not too distant future. We're going to do a webinar on potential black swans, things that could derail this market that aren't priced in, that aren't already expected. But I wanted to give you a little bit of a tease here on what one could be, and that's the fact that the yield curve is beginning to flatten. And when a yield curve flattens, it gets in danger of inverting. Now, if you're not familiar with how the yield curve works, usually when you're buying bonds, treasuries, something that has a time period denomination to it, you earn less money for the shorter term durations versus the longer term, which makes sense, right? If you're going to buy a 2-year bond versus a 30-year bond, you should get paid more for tying up your money for 30 years, so you should have a higher interest rate. Well, note what's going on here. This blue line is showing the shorter term rates are moving up and the longer term rates here. In this case, it's the 2-year, which is the blue line, versus the 10-year, which is the white. So the white line is going dead sideways, but note the increase in the 2-year. So you're not getting much of a benefit to hold a bond for 10 years versus 2 years. So who would want to do that? Why would you want to tie your money up for 10 years if you're going to get roughly the same interest rate for holding it for 2? So that obviously is worrisome to the markets, because normally when this happens, it's a precursor to a recession. So this is showing you what happens once the yield curve inverts. In other words, on that previous slide, it would be the blue line overtaking the white line. In other words, you would actually get paid more from an interest rate standpoint for holding your money for a short period of time versus a long period of time. That has been a great sign for upcoming recessions. And you can see here how it's predicted the last 7 recessions. And here's the blue line. So anything that drops below that means the yield curve inverted. And then immediately following that, you have one of these red columns here, which that's a period of recession. Now note, we are not at the point of inverting yet, but it didn't take much of an inversion back to forecast the big financial crisis of 2008 and 9, and that was certainly more than a recession, borderline on depressionary times there. But we're getting there, and it's just something to keep an eye on. This could be something that actually spurs on the correction that is well overdue in the markets. Not a lot of people are talking about it, and a lot of people that are talking about it are just dismissing it by saying, well, that's the Federal Reserve. The Federal Reserve is still keeping the liquidity pumps going. They're keeping rates down, and that's why we're starting to see the flattening of the curve and getting close to an inversion in the yield curve. Well, one thing that I've learned in nearly 20 years of trading options, focusing on Elliott Wave, focusing on the markets themselves, is when people start to say, quote, it's different this time, that is another warning signal. So again, watch for an upcoming webinar where we'll go into more scenarios like this that could potentially derail the markets, but know that we are getting into the point where if you're long the market, be very careful, tighten up your stops, put protections in, and make sure that you lock in your gains when the correction does come. And when it does come, when the volatility increases, we're going to have a lot of fun trading at that point in time. I can't wait. Thanks for your attention. Take care, everyone. Talk to you next week.